Approximately 90% of all first-time investors aren't able to make any kind of profit. Over time, 80% end up losing money. 10% barely break even, and only these 10% succeed. But why only 10%? Nowadays, success often belongs to those who know what action to avoid, rather than those who know what action to take. In this video, I will discuss 7 concepts based on my 6 years personal experience that can help you save both time and money by preventing mistakes before you begin your investment journey. I've been in the market since 2017 and have made several mistakes along the way. Normally, we learn from our own mistakes, creating our own experience that can be instrumental in helping us avoid similar pitfalls in the future. The goal of this video is to assist at least one person in avoiding mistakes I've personally made. By incorporating all 7 concepts in your investment strategy, your chances to join the 10% who successfully earn money from the market can significantly increase. First concept: buy low, sell high. Buy low means acquiring an asset when its price is really cheap or undervalued. Selling high involves selling the same asset when its value sustainably increases. Because markets are cyclical, especially the crypto market, assets tend to go through periods high and lows. Once I realized that buying low minimizes the initial investment and risk by forcing on potential future benefits, I started to earn some of my money from my investment, which I could spend for another project, or maybe I can spend on vacation with my friends. On the other hand, selling when the asset is on its peak value allows you to capture maximum return before a potential downturn. Buy low, sell high is effective, but it's not the only strategy to employ. Concept number 2: emotions control. Emotions play a significant role in the world of investing, frequently steering decision-making processes. There are 2 types of emotions. The first one is a fear. The fear in particular is a powerful emotion that can lead to a rational decision. Investors can become fearful during the downturn, leading to panic selling. Especially, I felt it during 2018 during the crypto bull run, when the market expected downturn after I bought some coins at the high price in 2017, 1 year before. That can lead to significant losses and missed opportunities to recover. For example, if you buy at the high price and then the market expected downturn, and when your asset fell down 60% from your current buying price, then you want to buy more, but you don't have any money because you put your all money the high price. And the second emotion called fear. The fear is a potent force that can drive investors to take excessive risk in pursuit of higher returns. This pursuit of grateful profits can lead to speculative behavior and the ignoring of proper risk management. While it may lead to short-term gains, it often leads to long-term losses. To this case, Warren Buffett said, "If you aren't willing to own stocks for 10 years, don't even think about owning it for 10 minutes." Concept number 3: diversification. Don't put all your eggs in one basket. Imagine if you have a dozen eggs and you place them in one basket. What happens if basket falls? You lose everything. This scenario is similar to investing all your money in one asset or investment. Or from my own experience, sometimes I bought some coins, only one coin, because I thought it will go up. And when this coin was falling down minus 20% in 1 week, I was really shocked. Since that day, I spread all my assets through to different baskets. What benefits you will get from diversification? At first, you will get risk reduction. By diversifying your investments, you can reduce the overall risk in your portfolio. For example, if your portfolio consists from some assets like gold, crypto, and stocks, and if crypto fell down, let's say 50%, you can take some money from gold and buy crypto. But when crypto goes up and give you plus 600%, you can take a little bit money from crypto and put it to gold or maybe to stocks. But in general, your whole portfolio will go up. And the second benefit from diversification is protection against market turbulence. When a particular asset class experiences a downturn, others may be up, balancing your losses, which actually allows you sleep better at the night. How to achieve diversification in your investment portfolio? There are several assets through which you can achieve your diversification. At first, we have stocks. Invest in a mix of stocks from various industries and regions. Second, we have real estate. Diversify your investment by buying physical properties or REITs, means real estate investment trusts. The third, we have cash and equivalents. I personally don't have any physical gold or silver in my portfolio that actually I might have had. But having some cash, not in your bank account, but like physical money on hand for emergencies, is essential, especially nowadays, because nobody knows what will happen tomorrow. And the fourth, alternative investments like new tech market with cryptocurrency, which might be very interesting, especially nowadays, because are at all-time low prices. And I use this situation to buy some coins to make the average price buy not too high, not too low, because I invest in the next 2 years in cryptocurrency market. Spread your financial wisely to protect your own financial future. The concept number 4, not giving your investment time to grow. When it comes to investing, time plays a pivotal role. Ideally, you should hold your investment as long as you can to maximize your returns, like I am planning to do with my cryptocurrency, holding them for next 2 years. A big mistake that investors bailing out on an investment because they didn't double their money in certain period of time, which is usually a couple of days or weeks. If you need your money to grow urgently, you probably don't have proper savings. Quick growth comes with a lot of risk. More about this in the next concept. Concept number 5, investing money you need soon. People jump into the market before building themselves a strong financial foundation is the biggest mistakes investors make. A big part of that is building a cash reserve, so you don't need to rely on your investments when you run into an emergency or when you wish to make specific purchase. The stock market can be volatile, and you would hate to lose the money you were saving for something like a down payment on a home you wanted to acquire. A good way to know if you are ready to invest is to understand if you have enough amount of cash in your saving account to cover all your short-term financial goals. Some investors suggest that money needed within a relatively short-term period, such as within 2 years, should not be invested. The concept number 6, hold strategy. The key principle here is to avoid unnecessary trading and instead focus on long-term growth of assets. It has 2 benefits. Minimize frequent trading. The first and foremost principle of this strategy to minimize buying and selling, to minimize the frequency of buying and selling the assets. And second, embrace a long-term perspective. It encourages investors to adopt a long-term perspective, and it's very important not to react on short-term market turbulence, because the likelihood that your assets will rise in a couple of years is higher than it will be rise in a couple of months. 3 reasons to adopting a hold strategy. First, reduce transaction costs, because if you buy and sell, you pay some fee for your broker, and also you might have to pay taxes. Second, it's emotional discipline. Reducing the number of actions with assets can help investors avoid impulsive decisions driven by market volatility. And the third, tax efficiency. Holding assets for a long term can lead to favorable tax treatment, such as low capital gain taxes. Remember, the hold strategy often requires patience and sustained focus on the long term, potentially leading to a higher returns. By minimizing frequent actions with assets, you can potentially achieve your financial goals much more quicker and more efficiently over time. The concept number 7, having clear investing goals. After establishing a dedicated saving safety net to rely on, it is essential to define your investment objectives clearly. When I started to invest, my goal from investing was to make more money. However, since then, I can come up to understand that money should be seen as a means to achieve other goals. Making investing all about returns is a common mistake. If you want to invest in alternative markets, in this video, I will be presenting my viewpoint on the cryptocurrency market, showing you one on my investing strategies in high-risk assets and educated my selection process. Thank you for watching, and I will see you in the next video.